Hi, my name is Latifa Poole, and my partner was Joanna Grabowska. Today we will talk about the following four cases: KPMG's questionable tax shelters, KPMG partner shares confidential information with a friend, Sino-Forest fraud, audit challenges in China, and Permalant, Europe's Enron.
Here in Victoria lives a family originally from South Africa. Peter Cooper and his two sons, Marshall and Richard,
In 2016, Panama Papers exposed an enormous amount of offshore companies that were used by the wealthy for the tax avoidance purposes. KPMG admitted to putting some of its Canadian clients into tax shelters on the Isle of Man for a fee of $10,000. Additionally, KPMG fought a court order not wanting to reveal the names of the investors. The Canada Revenue Agency offered a tax amnesty to those wealthy tax avoiders under the condition that they paid taxes that were avoided by investing in the Isle of Man. It was later exposed that executive officials that were granting amnesty to the KPMG's clients had attended multiple events and were entertained in a prestigious clubs along with KPMG personnel. They were wined and dined at multiple events sponsored by the tax policy committees of the Canadian accounting profession. KPMG was criticized at two levels. One of them was evident conflict of interest with KPMG entertaining government officials who are responsible for collecting taxes. And another one was that KPMG was criticized for acting inconsistent with the objective of the profession. Accountancy is a profession of public trust whose purpose is to promote the best interest of society, even at the personal expense of the professional accountant. Public accountants must always put the public's interest first. KPMG was not the only one using those practices. Let's talk about similar tax shams. In the 1990s, Ernst & Young designed 4 tax shelters that would delay paying tax on stock options for over 30 years. E&Y paid $15 million settlement to the IRS in 2003. In 2005, KPMG settled with government and paid $456 million fine and agreed to be monitored for the 3 years for the sale of tax shelters. In 2007, 4 Ernst & Young partners pled guilty to tax frauds selling tax shelters such as foreign currency options and shell corporations to some of its wealthy clients. In 2012, BDO paid a $15 million fine as a result of designing, promoting, and implementing illegal tax shelters, benefiting wealthy clients and costing government $1.5 billion. Meeting the public's expectations of how a professional should behave and how services should be performed is essential to the public reputation, especially after a high number of financial scandals at the beginning of current century. KPMG as tax professionals are expected to know the tax codes very well and advise clients on how to pay the lowest amount possible within the law. Nevertheless, the advices cannot be with an intention to avoid taxation.
Things got a whole lot worse today for Scott London, the former KPMG executive accused of giving out inside information about several big California-based companies his firm audited. They got worse, too, for his stock trader friend who benefited from that proprietary information. Jane Wells now has more on how those dirty deals went down, how much money changed hands, and the criminal and civil charges both men now face.
Quote, insider trading was like counting cards in Vegas. That line allegedly spoken by fired KPMG senior partner Scott London to a country club friend who was reporting on and at times recording information London was sending to him in what the FBI says was a huge insider trading scandal involving at least 5 companies. The FBI says this photo shows London accepting $5 grand in cash from jeweler Brian Shaw, which London allegedly believed was his cut for profits made on a tip about Decker's Outdoor, which sells Uggs. The feds claim tips like that made Shaw, whose jewelry business was hit hard in the recession, more than $1 million in illegal profits before the FBI confronted him and he agreed to work with authorities. London faces 5 years in prison and hefty fines if convicted. Despite what is assumed to be a nice income, the feds claim London accepted a total of 50 grand in cash and gifts from his friends, and earlier we spoke with Brian Shaw's attorney.
When Mr. Shaw came in at the beginning of this year, 2013, he came in without any deals, and he decided to go forward with the government fully, completely, and truthfully. To date, he has no deals with the SEC, no deals with the U.S. Department of Justice or the FBI.
One of the more interesting exchanges involves Herbalife. According to the complaint, London allegedly tipped off Shaw that Herbalife should beat earnings in February, and that should send the stock up. But, quote, he was concerned about hedge fund manager Bill Ackman driving down the price of the stock, and later after Carl Icahn revealed he had bought a lot of Herbalife stock, quote, Shaw told London, I wish you would have known that he was going to release that, and we could have made some money. London responded, yeah, that would have been nice. Both men have admitted in public statements that they regret their actions, Shaw calling his stupid. We'll have to see if that draws any leniency from authorities. For Nightly Business Report, I'm Jane Wells, Los Angeles.
Let's quickly summarize the facts. On July 1, 2013, Scott London, a former KPMG audit partner, pleaded guilty to securities fraud. Scott was passing confidential information to his friend Brian Shaw in 2011 and 2012. The information passed on to Brian Shaw included information regarding earnings announcement by Herbalife Ltd and Skechers USA Inc., planned merger of RCS Holdings with United Rentals, and takeover of Pacific Capital Bancorp by Union Bank. It is estimated that Shaw gained information that benefited him by approximately $1.3 million. it is apparent that London received cash and small gifts from Shaw for the information received. Subsequently, London was charged with 14 months in prison. London has definitely breached his professional duty by violating the requirements imposed by the Professional Code of Conduct. The Code of Ethics for Professional Accountants establishes ethical requirements for professional accountants. It states that in acting in the public interest, a professional accountant should observe and comply with the ethical requirements of this code. A professional accountant is required to comply with the following fundamental principles. Integrity. A professional accountant, as such we would have expected an audit partner to be, should be straightforward and honest in all professional and business relationships. Scott London violated integrity by using his position for personal and a third party's advantage. Objectivity. Scott London violated the principle of objectivity, allowing bias, conflict of interest, and undue influence of his friend to override professional or business judgments. Professional competence and due care. A professional accountant should act diligently and in accordance with applicable technical and professional standards when providing professional services. Scott London violated the professional competence and due care by not complying with ethical requirements. Confidentiality. Scott London, as a professional accountant, should respect the confidentiality of information acquired as a result of professional and business relationships and should not disclose any such information to third parties unless there is a legal or professional right or duty to disclose. However, London used confidential information acquired as a result of professional and business relationships for his personal advantage and his friend. And lastly, professional behavior. Revealing information that could potentially influence the price and stock markets is simply a security fraud. Scott London violated relevant laws and regulations and did not avoid action that discredits the profession.
A brief summary about Parmalat. The company was founded in 1961 by Callisto Tansey. The company was a food and drink manufacturer along with its subsidiaries and one of the leading firms in long-life milk, yogurt, and juice market. In December of 2003, Parmalat was declared insolvent after various allegations of fraud dealing with CPEs or special purpose entities off balance sheet where Parliament was understating liabilities in scam transactions. The fraud was finally inspected by PwC, and the scandal of Parmalat became one of the largest scandals in Europe, becoming the stimulus for a change in corporate governance in Europe. Now we will look at a few questions to help break down this case. First question is, what conditions appear to have allowed the Parmalat situation to get out of control? First off, Parmalat was putting its losses into fictitious offshore companies. It had about 200 different subsidiaries or companies that it was hiding its losses in. Auditors reviewing Parmalat were working in collusion with the managers. Its first auditors from Grant Thornton had been on them since 1996 and was still reviewing some of the offshore accounts. There was understating of liabilities and overstating of assets, which led to most of the fraud. Transferring of monies between Tansey family members who coincidentally owned 51% of the company's shares. This allowed for them to keep majority control over the company and also the board and audit committee. Next question is, what specific audit procedures might have uncovered the Parmalat fraud earlier? The auditors could have did tests of accounts receivables to ensure that these accounts were actually valid tests of their transaction processes. A lot of the fictitious companies, they weren't real, so testing how people were getting paid, if they were actually getting paid, would have been something to test for. Observation, actually going to these companies and seeing if they actually did exist, is another procedure that could have been done. What audit steps should Deloitte have taken with regard to the 17 offshore subsidiaries that continue to be audited by Grant Thornton? Deloitte should have reviewed prior work papers to determine what was being reviewed or what had been reviewed. Auditors should have reperformed prior tests to determine what types of risk or variances in accounts that could be found. What impact did the Parmalat fraud have on Grant Thornton? Causes Grant Thornton to look incompetent, like they cannot do their job or they were not aware. Grant Thornton could end up being pulled for audit by SEC for overlooking such large amounts of fraud or not finding them. Fees and assessments from SEC, or they could be dismantled altogether, much like Arthur Andersen. What areas of risk in Parmalat control environment contributed to the fraud? Members of the audit committee were elected by the controlling shareholders, who are also Tansey family members. This swayed their opinion. Board of directors never asked any questions when allegations began. Tansey refused to let minority shareholders participate on the audit committee, and there was too much faith in auditors and management. What areas of strategy contribute to the fraud? Moving companies offshore, this left ease for fraud to continue. Tansey acquired soccer teams, hotels, and travel agencies. This added to the illusion that the company was continuing to do well. Quick expansion into new countries and new product lines also added to this illusion and covered for the poor planning and rash decisions that were being made. Is independence important in corporate governance? And what is the most recent rules on corporate governance for public companies? Independence is very important for auditors, as is they need to be able to do their audits the most unbiased way possible. For companies, independence is important because they do not want to seem as though they are bribing the auditors in their favor. The SEC has currently 16 different principles in their 2016 Code of Corporate Governance for publicly listed companies. Principles 1 through 7 deal with the board governance. In this case, the board should have been looking over financial statements, signing off on these financial statements if they agreed. Principles 8 through 11 deal with disclosures and transparency. So footnotes for anything on financial statements disclosing liabilities, contracts, leases. Principle 12 dealing with internal controls and risk management, the type of risk companies are dealing with on a daily basis, how controls are being verified and put in place to make sure that fraud isn't happening. Principle 13 is cultivating synergic relationships with shareholders, so keeping them informed, not trying to put things past them or take advantage of shareholders. And the last 3 principles, 14 through 16, deal with the duties of stakeholders. Any suppliers, shareholders have the right to be a part of the audit committee. The minority ones, importantly. Board of directors, the audit committee, all should have been taking very stern looks at the company when allegations began. And now we begin the Sino Forest case. Sino Forest is a timber company operating out of China. Its divisions include tree plantations, log and wood product trading, and manufactured wood products. The market capitalization at the time in the U.S. was $4.2 billion with a stock price of $18.21. But on March 30th of 2012, Sino Forest filed for bankruptcy protection in Canada, and the troubles began. In the Muddy Waters research report, Carson Block makes the following allegations against Sino Forest. He says the sales transactions for standing timber were fabricated. For example, reported sales in Yunnan province exceeded the applicable harvesting quota by 6 times. He says that their assets were also exaggerated. Purchases of trees for planting have been overstated. Few legit agents have been used, and the other agents appear to have been laundering money from Sino Forest. Sino Forest engaged Jaco Poiri to provide credible valuation reports for growing trees. It was found that Sino Forest manipulated the data and restricted the scope of its work. Sino Forest was also accused of using offshore companies to obscure the transparency of audits and was accused of using forged documentation in their audits, which the auditors did not detect. And lastly, the Board of Directors, Audit Committee, and auditors were not familiar with the politics, language, and culture of the People's Republic of China. On December 3rd, 2012, the Ontario Securities Commission had a hearing with Ernst & Young LLC and had the following allegations. They had failed to verify Sino Forest's ownership in its assets. They had failed to verify existence of Sino Forest's assets. And they had failed to undertake their audit work on the Sino Forest's engagement with a sufficient level of professional skepticism. Although in their notes of the third quarter financial statements, they noted incomplete or inadequate record creation and retention practices, no integrated accounting system, and employees conducted business from time to time using personal devices and non-corporate email addresses. If things like this were found, then there should have been some sign that the auditors should have further investigated the claims of the company. They should have followed up with contracts, any kind of leases. They should have did on-site investigations of any of the assets to make sure that they are verifying existence and that they are verifying ownership of any of Sino Forest's assets. We will end with reasons for not catching the fraud. The auditors did not use sufficient audit evidence or professional skepticism. They relied on Sino Forest's documentation and took it as is. A part of GAS's standards, auditors are required to obtain reasonable assurance that the entity's financial statements are free of material misstatements. GAS also says that auditors are supposed to plan and perform their audits using professional skepticism. The GAS standards also talk about sufficiency as the measure of quantity of the audit evidence. The higher the assessed risk, the more audit evidence is likely to be required. The higher the quality of audit evidence, the less evidence may be required. If they are not able to assess and verify that assets or contracts are actually real, or there is no company connected to those contracts, then the auditors of Ernst & Young should have made note of this and brought it to the attention of shareholders. The other reason for not catching the fraud, board of directors did not make any effort to understand the allegations or issues that the Muddy Waters report stated. So once these allegations came out, there was no board meeting to say, hey, we need to resolve these issues. We need to investigate to make sure that there is no fraud in our company. These are important things as far as board of directors taking part in major decisions for companies, as well as auditors verifying and ensuring that the quality of their audits are up to par. And with this is the end of our presentation. Thank you.